Hello and welcome to Energy Insights, your trusted source for in-depth analysis of the global energy markets. Today, we have to cover key developments, particularly the LPG shocks due to the current situation in the Middle East region. Similarly, the Red Sea risks and the market volatility. So let's dive right in. So first we have to move to our segment one, which is the LPG market overview. The ongoing Middle Eastern conflict is sending shock waves through the global LPG market, highlighting how dependent supply chains are on stable transit routes. A key concern is the Strait of Hormuz, a critical choke point through which a large portion of the energy commodities, including LPG exports from the major Middle Eastern producers, flows. Any disruption here immediately tightens the global supply. LPG markets are particularly vulnerable because they rely on continuous shipping cycles, unlike oil. There is a limited storage flexibility, so even short delays can create immediate shortages. This has pushed propane and butane prices sharply higher, driven by supply constraints, rising freight costs, and growing uncertainty. Asia's feeling the impact the most. Countries such as India, China, Pakistan, and Bangladesh are heavily dependent on the Middle Eastern LPG. With supply tightening, buyers are turning to alternatives such as the United States, but longer routes and higher costs are limiting relief. At the same time, shipping constraints and higher insurance premiums are making logistics more expensive and unpredictable, further amplifying the price volatility. So overall, the LPG market is facing sharp supply shock combined with logistical challenges, making it one of the most impacted energy segments in the current crisis. So now we have to move to the segment two, which is the Red Sea shipping risks escalate. The impact of the Middle East conflict is also spreading into the global shipping routes, with the Red Sea emerging as a major risk zone for international trade. This corridor connects directly to the Suez Canal, one of the world's most important trade arteries. Any disruption here has immediate global consequences for both goods and the energy flows. Rising tensions are increasing the risks of attacks on commercial vessels, particularly from various groups in the region. As a result, many shipping companies are reconsidering their routes, with some opting to avoid the Red Sea altogether. Rerouting ships around southern Africa significantly increases the travel time and fuel costs, pushing the freight rates higher and delaying shipments. These disruptions are already impacting the global supply chain. There are also concerns that even strong naval presence may not fully secure the route if the conflict escalates further. At the same time, risks are not limited to one area. There are growing fears of simultaneous disruptions at key choke points. So the Red Sea is becoming a major pressure point for the global shipping, where the geopolitical tensions are translating into higher costs, longer routes, and increased uncertainty. So now we have to look into the market chart as a global commodities market snapshot. So turning into the markets, today's sessions reflects a strong reaction to the geopolitical tension, with energy commodities leading the gains. Oil prices have surged, with major benchmarks posting gains of over 4 to 5%, reflecting growing concerns over supply disruptions. Natural gas has also moved higher, showing spillover strength from the broader energy market. Refined products such as the heating oil, gasoline, and gas oil have recorded even stronger increases, indicating immediate tightness in the short-term markets and the downstream of the market side. Meanwhile, carbon markets remain relatively stable, suggesting that the current volatility is concentrated in physical energy markets. On the financial side, major equity markets have declined, reflecting a broader risk of sentiment among the investors as geopolitical uncertainty rises. So the energy markets are surging and the supply fears refined products are reacting most sharply, and financial markets are signaling caution, pointing to global market environment driven by the geopolitical risk. So with this, we have to conclude the today episode. So as we wrap up, the current situation is more than just short-term volatility. It signals that the global energy markets are entering a high-risk phase. From LPG disruptions around the Strait of the Hormuz to shipping uncertainties in the Red Sea, through the Suez Canal and rising oil and commodity prices, the pressure is building across the entire system. What stands out is how interconnected everything has become. Supply risk, freight costs, and market sentiments are all moving together, amplifying the overall impact on the prices and trade flows. For energy importing regions, this could mean higher costs, tighter supply, and increasing economic pressure in the coming weeks. Going forward, keeping an eye on the escalation or de-escalation in the conflict, security of the major shipping routes, and shifts in the global supply chains. So the final takeaway of today's episode is that the energy market is no longer just reacting to geopolitics, it's being reshaped by it now. If you found this analysis useful, don't forget to like, subscribe, and follow Energy Insights for more updates on global energy markets. Thank you for watching Energy Insights.